When you're deciding the best entity to set up for your technology company, there are a number of non-tax and tax factors that you should consider. The primary non-tax factor is the financing of the technology company. As we've been talking about, technology companies often are seeking venture financing, and venture capitalists require the company to be set up as a Delaware C corporation. This is because the laws of Delaware C corporations are very familiar to venture capitalists. Venture capitalists also need to have the company set up as a C corporation because many of their investors are tax-exempt entities and can't invest in a pass-through entity like a limited liability company or an S corporation. If financing is imminent for the technology company, then this is going to be the primary driver to setting up the Delaware C corporation. If venture financing is not imminent, then the founders of the technology company need to look at other non-tax factors to determine whether they should form a limited liability company or an S corporation. Other non-tax factors include who are the owners of the company. If the owners of the company are not U.S. citizens or resident aliens, then they wouldn't be able to form an S corporation. So they need to form either an LLC or a C corporation. Other non-tax factors for a technology company include limited liability and forming an entity to ensure that there is no liability for the founders of the company. Also, it's important to consider the exit of the owners from the technology company. And what this means is, how do the owners anticipate transferring their interests to outside investors or other companies? For a lot of technology companies, the exit is often being acquired by a larger company or taking the company public. For a technology company who does not have imminent venture capital financing, meaning they're not going to get venture financing within the next year or a couple of years, then they need to consider a couple of tax factors when determining which entity they should form. Those factors include whether there are likely to be losses from the company. If there are going to be losses from the company that the founders can take advantage of, then the founders want to consider forming a limited liability company or an S corporation where they'd be able to take advantage of those losses on their personal taxes. Since most founders in a technology company are going to be actively involved in the company's business, they'll have to pay self-employment taxes depending on the type of entity that's formed. So it's important to consider whether there is an entity that's more favorable in terms of paying or avoiding a certain portion of self-employment taxes. For example, with the limited liability company, founders who are actively involved in managing the company are responsible for paying self-employment taxes, whereas founders in an S corporation are able to pay themselves in the form of wages as well as in the form of distributions from the company. And any distributions that are received are not subject to self-employment tax. So it's important for founders to talk to an accountant to determine whether it makes sense to form the LLC or the S corporation if venture financing is not imminent.